Hi, everyone, and good afternoon. Thanks for tuning in to today's Market Color Call. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any follow-up questions after listening to the webinar, please reach out to Jordi or the marketing team. We would love to hear from you. A replay will also be available on our website. Jordi, the floor is yours.
Thanks, Amanda. Hi, everyone. April 30th was the last time I did one of these, and I just wanted to kind of update on things that have occurred in the last few weeks, ranging from actual data that's come out and kind of changes that have happened in the marketplace. But I want to start just with a few of these little cutouts on the screen. I think it's really important for people to continue, based on the conversations I'm having, to remember what we're in. I really do believe too many people are ignoring the fact that this is a new regime in terms of monetary theory. It continues. The last time I showed how large the numbers were, and I've been saying more and more to people during these types of presentations, if the amount of money printed was $40 trillion, would you be positive at that point? And that question has led to a lot of more discussions. And I just wanted to kind of go through this because I still believe that the thing people should be focused on, using the Kentucky Derby analogy that I did the last time, is that the positioning is still geared towards technology, healthcare, and against everything related to inflation and the possibility of a supply shock. As a result of both the pandemic, the tariffs that have gone on, but also in addition to some of the things I mentioned related to ESG, and the fact that this is a completely new type of environment with the monetary change that's happening. So a couple things on here. This is an important thing that came out last night, and I think if you're talking helicopter money, now we're getting to the point from a Republican senator willing to give money for people to go back to work. At the same time, we have this phrase that I've been using internally, which is we've been in an environment for really 40 years of just-in-time inventory, and now a lot of the things we're hearing from companies and from individuals, and we're seeing this obviously, is rather than focus on a just-in-time, as we go through this deglobalization and fears about a second wave remain, there's a hoarding going on, and it's just-in-case inventory, just to make sure you have extra in case this ever happens again. And then the data that I'm going to go through is going to go through a lot of things like the grocery prices reaching 50-year highs. It's just surprising to me that 3 weeks after, with the amount of stuff that has come out, that the majority of people are still negative, and they do not think there's any chance really of inflation that'll last. So from there, I'm just going to show one more thing, which I think is the most important for you to leave from here today, and a lot of what the conversation will be in the charts. One of the most important things for investors, particularly going from deflation to reflation, is when the ISM gets back above 50. And as you can see here on a survey that Merrill Lynch put out this week in their fund manager survey, you can see that right now, the majority of people, it's actually over 70% of people in the market, believe that the ISM will not get back to 50 until at the earliest the fourth quarter of 20. As I go through these, it looks to me like it is much more likely to happen faster than that. So I'll go through a bunch of charts, and hopefully this will help you see some things maybe you haven't seen before. First, on the inflation data, here is the most recent Conference Board Consumer Confidence 1-year inflation data. If I take this back to 14, you can see it more. A large jump in 12-month inflation expectations. That was in one of the consumer confidence ones. This came out more recently. University of Michigan, also a large jump up to the highest level since 2014. In addition, we had the release of the CPI, and inside the CPI, you had the 1-month food at home component. Jumped to the largest level since the 70s. All this again during a deflationary period. More interesting to me is within the ISM number. You may have noticed that the number that was released in May came in at 41.5 above expectations. I've not seen a lot of press on this, but with inside the number, you had obviously a large drop off in new orders with a complete shutdown. But this is the supply delivery time, which jumped to the highest level since the 70s. The only time we had been up here was in this periods in the 60s and 70s. So we clearly are having bottlenecks due to the virus. This highlights how irregular that was. So the red line there is the actual PMI data, which went down, like I said, to 41.5, while this went up. This is very important as we go through this, because if we don't improve on the supply delivery time, that increases the possibility of us getting back to 50 earlier than what people expect. The reason is because they're all part of what computes the headline number. So if delivery times stay high and prices paid go up with what commodities are doing right now, you will see a faster bump to 50, I think, than people expect. And that's part of what I'm going to go through today as you look at this. In the non-manufacturing, we saw a very similar story. This is the supply delivery times. We only have data going back to 97 in the non-manufacturing, but even from the service side, we saw the exact same thing. And then for the prices component was even more surprising. Prices on the non-manufacturing service side actually jumped 5 points in the month of April when everything was shut down. So we're already seeing some kind of difference that has happened in the past, and it's best emphasized by this. I mentioned that the PMI was much greater than what you'd expect. Here's the difference between the PMI and the new orders. And this is the way I strip out kind of the inflationary or supply shock side of this. So you're going to want to see what happens if supply delivery times actually stay high and we get a bounce in new orders, which everyone should expect because of the reopenings. Then what you're going to see is a much closer number to 50 than people expect. So it's something just to keep in mind as you go through this. I think it's very important for people to remember this as they go into the next PMI coming up shortly. In terms of things that are leading indicators that I use to look, the ZEW out of Germany came out, a large bounce. This is it overlaid with the PMI in the US. And if you go back and you do this on your own, you will see that historically the expectations component of the ZEW leads the PMI by at least a few months generally. The interesting component is we had seen a big bounce in this in the fourth quarter of last year. It obviously came back down with the ZEW, but most people were expecting at the beginning of the year some sort of reflationary type environment. They're not jumping back on that now, yet the indicators are now showing the exact same thing as they were in the fourth quarter. So you've got a sentiment shift. This is the Morgan Stanley's business conditions expectation. This comes out earlier. You've also seen a big bounce in this too. The only three bounces that we've seen larger, one again in that fourth quarter. These are actually the only three bounces we've seen at a similar level. This did lead to a bounce, but then we had the pandemic. You had one here, which was coming out of the European crisis when Draghi basically announced that they're all in. This started a long-term rally in the ISM, and then obviously the one back here is self-explanatory. That was in March of 09. So this is a good leading indicator for what you should expect on the headline number. I do want to keep emphasizing this because I am surprised how many people are ignoring liquidity. I remember hearing people that traded during the late 70s and early 80s that waiting for the money supply release was the only thing that was important, and focusing on payroll data didn't make any sense. Well, we have right now M2 continuing to grow, and I think it should be turning people much more positive than it is. It gets back to that point of how much printing is too much. We don't know, but we know that it's having an impact. Here, going to China, this is the operating rate for the refineries in China as they continue to ramp up. This is a chart going back to 2011. So China is clearly continuing to move forward on their economy. This was the auto sales for the month of April. I mentioned in the last webinar that I expected this to come in somewhere around the 62% retracement level. We got above it. It got a lot of headline news because when you look at it on a year-over-year basis, it went positive for the first time since 2018. So clearly, I don't know how people don't see V's. This is a V. I would expect U.S. auto sales to also have a V, maybe not to that extent, but most of the leading indicators we're seeing on that front do suggest it's going to happen. The major reason, again, I'm just going to bring this chart up, coming out of 08, it took us all the way to here to get our SAR number back up to 62%, where it took China effectively 2 months. It took us all the way to the December of 2011 to get back to 62%. That was off a peak in 07. So we were talking literally about a 4-year. The speed of this move is big, and I think people should anticipate a very large bounce in this. And the reason I have it overlaid with the S&P is it shows the correlation. The S&P has already made back the 62% retracement line, and we're sitting at very important technical levels that we speak, that if we break, I think you're going to see a short covering rally, a fairly large proportion. And the reason is, this is the most surprising piece of data for me in terms of talking to people. It matches up. This is the 5-week moving average, or the 5-week average of the AAII net sentiment. The last time we were at these levels or close levels was in February of 16, before we started the large rally coming out of that problem. And then the time before that was March of 09. When you put that into context, that we've already rallied 30% in the market, and people are more bearish now than they were at the peak of the pandemic. I think this should be scaring anyone who's continuing to talk negatively about equities. The sentiment is a crowded view on the negative side for sure at this point. I want to show how important this has been to show that it does matter. I put lines in here for those 2 times in terms of where the PMI was. The reason I bring this up is over time, the AAII net has been very instrumental in kind of saying how people were worried about deflation. So to put us at these levels, that's also matched up with the low in the ISM that lasted for a long time, and the low here in the ISM. So it has a lot of implications, not just for the direction of the market, but generally when the ISM is low too, that is where you get these regime shifts in the marketplace. And that's where I think we are right now, towards the reflation regime. This is using it now and doing it in terms of reflation. So this is now showing the points in time where we've been down at these levels and what has happened to cyclicals versus defensives. I mentioned this last time, and I think we were somewhere right around here last time. Cyclicals versus defensives have continued to move higher. This is the 63-day rate of change. In each of these lines here, we reached at least a 10% level, which means there's still a lot of room for this to go. I would continue to focus on cyclicals versus defensives as the way to reflect the reflation trade. This gets into the PMIs versus another thing. So I'm going to kind of now go through a bunch of charts which are indicative of a PMI that you should expect to be going higher based on what assets are doing. So this one combines the Asian dollar index with the CRB spot index level. These are the periods in time where we made a low in this. It typically moves slow on the ADXY CRB. For those of you interested in this thing, I just combined the 2 of them, but it matches up with the PMI moves. We bottomed in this back on April 24th, and we've been gradually moving higher. We're at the highest level since the pandemic bottoms were made. So we're continuing to make progress in terms of the currency and commodity side versus what you should expect in the ISM. This is my risk grow index, which combines the dollar, commodities, and stocks all as one index overlaid with the PMI. So we've seen this bounce higher already, suggesting based on this move that the PMI could get as high as 50 in the coming month. I still think it may take a little bit longer, but certainly not the 4th quarter. This is the metal curve, which has been trading higher. So metals have been doing very well, particularly iron ore, as China's been leading the way out on their infrastructure side. This is the overlay of the metals curve with the PMI. It led on the way down as the tariffs went in. It led on the way down before we got the results, and now it's going higher and also suggesting that we're going to see higher prints in the coming months. This is an interesting one, just because, again, as people remain focused, I don't think they're paying attention to what's been leading. This is all the returns for 6 different sectors since the lows in March. The white line here is the best performing sector, up 63% since the lows. That's the energy side, the energy sector. Here, the second one is the consumer, durable, and apparel one. The third one is the auto components and cars. And the fourth one is materials. Healthcare and tech are here. So despite the fact that people think tech and healthcare are leading this rally, they are not. This is the S&P 1500. It's being led by energy predominantly at this point in terms of the best performing groups, but also the consumer spending side and the material side, which is more representative of coming out of a recession. So I would continue to look for that those groups as leading indicators. Speaking of crude, I mentioned on the last one that I thought the most important thing would be how crude would trade relative to the sentiment when it went negative. Since that time, we've gone obviously straight up. This is the front month crude price, but it's overlaid with 5-year break even. So I mentioned back then there was a massive divergence, which I thought was interesting. When crude had gone negative, the tips had actually stayed higher with a lot of the other indicators. Now they're all pointing up together, which is a much more confirmation of the reflation trade. This is the risk grow index now overlaid with tips, and again, confirmation. They are both turning higher. Whenever I get things syncing together on all my data, it argues strongly that we're seeing that. It means the breadth is growing and we're getting contagion on this trade. I think it's interesting that crude prices have already started to go up meaningfully, and this is the rig count. Which just took out the lows and is back at the levels when the fracking boom started. It'll be interesting to see what happens, but again, this gets into how quickly we can turn supply back on if the demand comes quicker than people think. This is 5-year break evens, and what I did on this is overlaid right here with 10-year yields in the US since 2001, and obviously we've gone from 5% down to 68 basis points. These lines in here are all the times where the break evens have been below 50 for more than I believe 30 days, and then we break it. We recently broke the 50-day moving average on the 5-year break evens. This has been an incredibly profitable strategy. You've made money 11 of 13 times by shorting bonds or playing for rates to move higher on the long end of the curve when tips have broken through there after a minimum of 30 days. The reason that's important is because, again, we've been in a disinflation regime for a long time, and every time that we've had tips down, it's usually been a sign when sentiment has been very bearish on deflation or disinflation. So 11 of 13 times you've made money in something that has gone down from 5% to 68 basis points over the period. So I would pay attention, and I expect rates to move higher as part of this reflation trade. In addition, this is the cyclicals versus defensives is the orange line, and this is overlaid with that dollar index, the Asian dollar index with the CRB. Again, just showing how linked these markets are together. We haven't seen a big jump in the Asian dollar index. That may change this week as China most likely unveils their infrastructure package. I would watch to see how the Asian dollar goes, but we are seeing other dollar action, which is important, mainly versus the European currencies, but in the others as well. This is the cyclicals defense, just to show how strong it's been on a short-term basis. This is the Morgan Stanley inflation versus margin squeeze index, which has gone higher as well and is at the highs since the lows. This is the SOX over the NDX relative to the PMI. It never really did sell off all the way. I've always used this as an indicator for cyclicality with inside the technology stuff. It's not having a big bounce, but on the days that most of the other stuff is up, like today, it is up again today. So I would just keep your eye on that. A lot of these I'm going to show you are just things to watch that I expect if there's a reflation trade to work. Small cap over large cap should work. It hasn't worked well yet, but it has been bounced off the low. Small cap has outperformed. There is a big short position with inside the small caps versus the large caps. So that's another place where I would expect to see it and what I'm looking at. This is the early late index. This is a Morgan Stanley long short index of long the early names, short the late names. This is usually representative of coming out of a recession. It's overlaid with cyclicals versus defensive. So again, you can see all of these things pointed the exact same way and been very correlated for some time. They're all saying the same thing. This is the discretionary over the staples. I showed this the last time. It continues to go. Even if you think that this is solely based on Amazon, if you did the multi-line retails, which are the mall names, they have significantly outperformed staples since the lows as well. This is the cyclicals versus defense, getting into the dollar now and the relationship of the dollar. The dollar has actually had a big move over the course of this week. We are still kind of in a trading range, which I'll show. But if the dollar is going to weaken, which I think will be one of the surprising stories out of this, it has huge implications if that does happen. This is the long-term chart of EEM over the S&P inverted. That's the orange line, and the white line is the dollar. Basically, as the dollar has been stronger, and we made all-time highs in the dollar here, emerging markets have underperformed the S&P. This is a very important relationship from my days in Brazil, and the positioning is all geared towards one side. So I think if the dollar is going to start a weakening trend, which I believe it will, you're going to see a change, most likely a regime shift in emerging markets versus the S&P. This is the dollar index, just showing we've been in a range. We did make the highs here. We are going down, but I would continue to watch it because it's starting to gather some steam, and there's a few things going on. A reflation trade almost always has the dollar involved. This is the emerging market currencies relative to the dollar. So these are even finding a way not to go down, despite the fact that the emerging markets, particularly Brazil, is in the worst phase of the coronavirus along with Russia, but they are hanging in there and doing okay on the currency side. I would watch those to show that EM equities are actually doing better than what people expect. The orange line is the EEM that people follow. EMQQ is kind of their NASDAQ version of it, or the tech version of emerging markets. That has just broke out very high during this, so it was moving together with everything. It has moved higher, so I would continue to watch that one as well. Anything where you start seeing the orange line go higher with this would be a reflation trade to me, and it would also mean that the currencies go. In Europe, Euro Swiss, I mentioned the last time, is one of my most important indicators. It doesn't need to go up violently, but what I do want to see is it not going down. It did break through the 50-day moving average, which historically has been an important sign. The last time we saw that was during the September reflation trade from September to December. I would watch Euro Swiss, and in particular, since we did get news with Merkel and Macron coming together on something which may be a shift in Europe, I would watch to see how the voting goes. But I would expect that if you can get Europe to do anything positive, people are underestimating the impact that it can have on all markets and all assets, as Europe has been kind of in this phase now for the better part of 8 years, having an impact on the global economy. This is the dollar index overlaid with momentum in US stocks. I bring this up because since the lows, they've been very correlated, and it has big implications if the dollar continues to go. This is really to highlight that regardless of what money you're managing right now, many people with inside the equity market have on a synthetic macro trade related to the dollar, which synthetically is against reflation. This is showing growth versus value, the orange line. I showed this last time. Quality versus beta has broken down and has continued to do that. The market is moving into beta. Normally that means that value outperforms growth. That has not happened now, but I think one of the reasons is represented by the sentiment that people still have, believing that a second wave is coming and that the pandemic is still the dominant decision-making tool rather than the reflation side. If we get reflation, I expect this to mean revert as well. So watch growth versus value in the coming months. And the reason it's important is, I brought this up last time, I'm just going to highlight it. We've seen some mean reversion on this, but just as a reminder, opportunities come from periods like this. So this is the difference between the short side of value relative to the S&P and the long side of the value relative to the S&P. So it's the ratio or the spread of these two charts here. So we've seen the cheap names get cheaper and cheaper relative to the S&P. The expensive names get more expensive relative to the S&P. And most of this damage has occurred since the tariffs came in. Most of the stuff down here is related to the reflation. Most of the stuff up here is related to disinflation. If we get a regime shift, I would expect a violent move the other direction. That's all I have today. It was a little bit longer than normal. As Amanda said, please reach out to the marketing team or myself if you have any questions, and I'll come back when the market gives us more to talk about.
And that concludes the webinar. Thanks, everyone.